welcome to the Portfolio Manager, a show where we try to get into the minds of the person who is managing a portfolio of public money to try and understand why she or he has built the portfolio with the construct that she or he has, and what is the kind of ideal return that the person envisages looking at the current economic landscape. Our guest today is Abhay Agarwal of Piper Serica. Viewers, for details, Abhay and Piper Serica manage and advise on an AUM of almost 800 crore rupees. They target an annual return of 18% post fees and expenses. Ideal holding period of about 3 to 5 years. Abhay, great having you. Thanks for taking the time out.
No, thank you, Niraj, so much. It's a pleasure to be on your show on NDTV Profit, and looking forward to the conversation.
Yep, likewise. So, Abhay, is it going to be difficult to do this? Because if the corporate commentary that is coming in the last 24 to 48 hours is sounding a bit mixed, because we heard Bharat Forge say that things are looking slightly difficult. On the other hand, Cummins came in and said that no, as of now, client conversations are not that off, and a lot of markets a lot of sectors in India depend on the global markets, and they are not necessarily looking the strongest.
You're right, Niraj. I think I was surprised personally by the commentary of Bharat Forge. It's a very strong player, so it came as a bit of a surprise. But it is also quite natural that the environment that we are in, with a lot of global flux in shipping, in inflation rates, interest rates, corporate earnings in the US and Europe, I don't think we're in a situation where any company can come in and say that, look, I have absolutely clear visibility of growth for next 2 years. I think there is expectation and optimism, but still till it translates into orders, nobody is going to go out in this market and say that, because we have also seen, Niraj, that you underperform in one quarter and what happens to your stock price. I mean, the stocks are priced so finely that managements of most companies are not willing to go out, make a very aggressive forecast and then underperform, because the markets will punish them. So I think it's just the nature of the markets right now. The corporate commentary is just reflecting that nervousness. But I think that also gives astute long-term investors opportunities, Niraj, to make their own bets, amongst this noise that we are going through.
Got it. So what's the portfolio construct in such a scenario, Abhay? Because, I remember you moved the whole distance from being, I don't know if it was 1/3 cash, but a large portion of cash, to even further lower. What's the portfolio construct between the different themes and the cash on the books, and why is that the case?
So you're absolutely right. I think towards the end of third quarter last calendar year, we had got into cash because we were nervous about the whole trajectory of Fed interest rates. And normally we don't take cash calls, but this we thought was an extraordinary event. And we also had made good money in our small and mid cap bets. So we wanted to book some profits and get into large caps, get a little defensive, because we thought that the environment globally and in India was a little volatile. However, things changed pretty quickly. We were surprised how fast Fed changed its stance to, keeping the rates to where they were and actually indicating a cut middle of this year. So that gave us a confidence that, look, we don't need to sit on this much cash and then we can deploy it. And now where we are is we have like 6% cash in the model portfolio. But what we have done, Niraj, is that since we have a very long-term approach and we are not really looking to churn portfolios very often, what we are looking at is backing the long-term opportunities that we see will make the kind of returns that you mentioned for our portfolio. We're not trying to do anything extraordinary. We don't want to take too much risk. Our investor profile is such that they're already wealthy. They are, family offices, ultra HNIs, and their mandate is that, look, grow the capital at a sensible level without trying to take too much of risk. So we like to keep the portfolios de-risked as much as possible. Can't escape the market volatility. But where we are now is that we have cut down our allocation to large banks and NBFCs. We are just about 20% there. We have a large segment in our portfolio that we call financial services companies, which are not lenders, companies like Angel One, CDSL, CAMS. We see these as very long-term plays. We're not even looking at them for 1 quarter, 5 quarters, or 10 quarters. We're looking at them as next 5-year, 10-year plays. Then we have added agrichem in our portfolio, and right now that bet is flatlining. But I think with the focus that the government has on boosting the agri economy, there are companies there that will do well. Pharma, large cap pharma has been a contra bet for us for last 6 months. We added three names there, and they have actually already done well. So we are quite positive on large cap pharma because of various reasons. And in autos, we have one bet. So I think that's the portfolio construct. We don't have any IT names. A lot of people are surprised, but I think IT we still see struggling for growth for 1 year. So once we see positive commentary, we'll probably add to that. So Niraj, that's the broad portfolio construct. I would say it's a mix of small caps, mid caps, because they have a flexi cap strategy. About 30% is large cap, 20% mid cap, and 50% is almost 50% is small caps.
Interesting that you're preempting stuff in pharma, but you're not wanting to preempt in IT. Why this differentiation?
No, IT, in pharma, Niraj, we can clearly see over the last 3 months, we have seen multiple things happen that make us, believe that trough has been reached in the cyclical business of generic pharma exports. One is that the extended supply or dumping from China has ceased to a large extent. And in generic pharma, our companies were struggling because the pricing power was lost and they were making money, but barely any money to cover costs. So we see a margin improvement as prices have increased. The second thing we are seeing is that raw material prices coming out of China have dropped, solvent prices, some of the per truck prices have dropped. Third thing we are seeing, Niraj, which is again a very good long-term macro play, is that US FDA has become friendlier. And I don't know what the reason for that is. I mean, is there a political overtone to that? Or is it because US is running short on generic supply for its domestic market? But whatever it is, the US FDA is not as combative. And I think a large credit, actually, I should also give to our companies, our large pharma manufacturers, that they have learned how to comply with US FDA standards. They have learned how to come up with the best of the manufacturing facilities in the world in India. So we are not at all worried about US FDA actions that used to destroy value a lot earlier. And another interesting thing is the pipeline of new launches, both in the US and in India, I think I haven't seen that kind of pipeline. So you look at companies like Dr. Reddy's, Lupin, Sun Pharma, I'm just taking names, these are not my recommendations, but across the board, you will see very strong pipeline of launches. So that is giving us the confidence that, these companies are trading at very low valuation compared to their upcycle, multiples. So there is, I think, enough good money to be made over the next 3 to 5 years is what is our bet, Niraj, in this space. In IT, we are not making that bet yet because we are not seeing any signs of recovery. We are not seeing any increase in customer demand. We're not seeing any, innovation coming out of IT services companies in India that is leading them to increase their margins. So once we see that, Niraj, we will definitely consider adding those also.
Okay, so you are saying that when it comes to information technology, you're okay to buy the stocks 5, 10, 15% higher, but you might as well wait for a change in trend because it's almost impossible to predict that change in trend.
Yeah, in the current environment, yes, it's a very competitive market. And I think, unfortunately, the Indian companies seem to be caught like a deer in the headlight when it comes to innovation and adopting new technologies like AI to drive efficiencies for their customers. And I think some of the recent losses of large contracts is probably because of a reason for that, that their pricing is not able to match what the customers expect them to do.
Got it. Okay, so that's as far as, then therefore I want to extend the conversation because let's kind of in this segment kind of talk about some of those export oriented businesses. You mentioned that you are surprised with the commentary of Bharat Forge. You've given us your rationale for pharma, IT. I want to extend it to agrichem. By the way, pharma, you are significantly overweight related to weightages. So if it does well, kudos, great for you and your investors. But agrichem, here, while Abhay, just playing the devil's advocate, that the commentary is not necessarily sounding very jovial. And there has been some commentary around green shoots now available in the last couple of quarters from Indian companies, even though global companies, company after company has said that there is pain. At least until 2024, there was pain. So out here, are you preempting or are you seeing signs of some revival? What is the rationale?
So we have three companies in our portfolio, Niraj, in the agri-chem space. Two are Indian, they cater to Indian farmers. One is Dhanuka, other is Bayer crop. And then we have a large play in form of UPL that we recently added, though the commentary, as you said, is still pretty weak. But I think the kind of extended down cycle these companies have gone through, we would like to believe that we are towards the end phase of that, maybe a quarter more, maybe two more quarters. But again, we can see some of the key product prices inch up as the dumping from China has reduced and is reducing as we speak. And I think that is what will help them increase margins. The domestic companies, like Dhanuka, very small cap company, just expanded capacity, has a very good product portfolio, new launches. Bayer needs no introduction, one of the best players in India, top players. So we believe that these companies will get volume growth, will get higher margins, because the government is very focused on making sure that the farm level income increases. The BJP has a stated objective of doubling the farm income over the next 5 years. And I think that is going to be a big focus area for this government. But I'm saying, leaving that also aside, just the economics of it, that the farmers will need a better yield on their, farmland, and the farmland is not increasing. So all that you can do is increase the yield. And for increasing the yield, you need herbicides, you need agrochemicals, you need fertilizers, you need crop protection, all kinds of chemicals. And I think that is where these companies with a very solid value chain will play that upcycle when it comes. So you're right, Niraj, we may be a little early in the cycle, but we know that the valuations will spike pretty quickly once the numbers actually start hitting. So that's why we have a 13.5% allocation to this space, which we are happy to hold for the time being.
Okay, Abhay, may I ask you now to talk about the inward-facing themes that you've bet on in your portfolios? I heard you mention that the bets on some of the banking and NBFC names have been cut down. It's about a 20.5% allocation. In select cases, except for PSU banks, private banks are actually trading at possibly the best trailing 12 months or maybe even a 1 year forward valuation that they have traded in the recent past. Why is it that you've cut the allocation?
I think there are two reasons for that. One is a structural business issue that these banks are now struggling for two things. One is access to cheap deposits, that drove their margins earlier. I think that access to cheap deposits in form of constantly increasing CASA has probably hit its upper level now. And I think any incremental gain in that is going to be pretty small. So there is going to be a cost side inflation as depositors want a higher return for the money that they put up in these banks. The second thing is that the opportunity space on the credit side is very competitive. If you want to go and lend to very good quality corporates, that's become very competitive, with the PSU banks also becoming very competitive. In fact, SBI, PNB, Bank of Baroda are giving all the private banks a run for their money as far as corporate finance deals are concerned. So where do you go? So then you go to retail, and retail is a large franchise. But again, as long as you're going to do mortgages or secured lending, the margins are limited. And then willy-nilly, what you're left with to drive aggressive growth in the book and margins is to drop down to unsecured lending or close to that. Now, that is a space that is infested with microfinance companies, small NBFCs, who do a very good job at that. So I think the large private banks, most of them are really struggling for growth right now, because either they sacrifice credit quality, or at the same credit quality, the growth is going to be not equivalent to what it was. And that is the fundamental part, Niraj. The other part is the technical part. Now look at the valuations, as you mentioned, they are probably, one of the lowest end of the valuation range if we go back to last 15, 20 years. But at the same time, if you're an FPI investor, if you're a foreign investor who doesn't really have to invest only in Indian banks, you would look at Indian banks and say, wow, these are the most expensive banks in the whole world. You can buy, you look at Citibank, Bank of America, JP Morgan, all these are trading also at almost single digit book value, 1.5 times book value multiple, international level franchises that are, fairly de-risked because of their global nature. So as an FPI investor, you always toss up and say, look, instead of buying a very expensive Indian bank, maybe I can just buy a Citibank, or, if I need to increase my banking allocation. And you look at some of the Chinese banks, which are trading at, ridiculous 0.3, 0.5, 0.25 times book value. So if you look at the technical factor and if you look at the fundamental factor, I think there is a case that it is better to, the question is, what kind of return can you really generate backing these big banks now? Are they going to go into a business restructuring, technical valuation correction zone for some year before you start looking at them again?
Okay. Domestic themes, and I have two more themes to talk about with you because I know that you track them so closely. One of them is something that you mentioned, which is capital market plays. I heard you say that you bet on them for 4, 5, 10 years. So there is one thing for somebody who's buying for 12 months, Abhay, the near-term valuation becomes a concern or becomes a factor, and therefore you may hypothetically not want to buy something at 30p, but okay to buy it at 25p. But if you're betting on them for 5, 10 years, then frankly 25p or 30p may not make as much of a difference, right? Especially for an individual investor, because आपको returns तो कहीं दिखाना नहीं है. So my question is, what is the thesis behind the longevity of some of the capital market plays? Is it that the number of investors are large and this markets will deepen? What is it?
Sure, and Niraj, you said it so well just now that, if anybody, that in the short term, the short term outlook drives valuations, but long-term perspective drives returns. That's the truth. So the longer you can see, the farther you can see, the better is your probability of making returns. And frankly, I've seen that the investors that we have, they are looking for compounders that will compound at a sensible valuation, and we are fairly valuation. We pay a lot of attention to valuation. We are not investors who would like to buy quality at any price. For us, returns come when we pay fair valuation and let the companies compound growth. So some of these companies look expensive, CDSL, CAMS, Angel One, and they have been historically expensive. We have them in our portfolio since their IPO time, and they have delivered excellent returns for us. And the reason that we are backing them, Niraj, is that as the financialization of savings takes place, more demat accounts, more trading accounts, more mutual fund accounts, folios getting created. These are companies that are completely driven by technology now. So their margins keep improving because they don't have incremental costs as much as the revenue growth. So you're in a beautiful space that you have a highly consolidated industry, 2 players at max, 3 players, at best in these industries. And your business, you don't spend any money marketing because your business is all inward, it's all inbound. And with that, as India becomes from a $4 trillion market cap, becomes an $8 trillion market cap company, these businesses will triple or probably quadruple in size just to support that growth. So if you take that 5-year view, 8-year view, and say that what these companies can become, 4 to 5x of their current market cap, then I think the attention goes away from their near-term P multiple to looking at, what is the problem, what is the wealth that I can create. So I think that's the bet, Niraj, that we are making in these companies.
Okay, they would become 3x, 4x their current size while the market doubles, because you're saying the market is consolidating, and therefore these players, which are large and if not monopolistic, then the dominant ones, will keep on gaining an incremental larger proportion of the new market that comes in.
Yes, absolutely. And okay. They don't have the cost structure. They can scale up very rapidly. They don't need to build new offices. They don't have any capex. They don't need to hire as many people because technology is driving their entire business growth.
Got it. Got it. Okay, Abhay, I was doing some work on the hotel sector because we've spoken about this in the past. Now, just a basic, and I don't know if you agree or not, but this is what stood out per se, that if I just aggregate the entire hotel market cap to earnings, then the Indian hotel sector kind of trades at nearly 10, 11 times price to sales. Very expensive relative to global peers, right? My question is, we've spoken in the past about this being a great domestic opportunity. Tourism is booming. If anything, the Prime Minister, the budget, etc., all lays emphasis there. Are hotels a good way to play tourism? Why or why not? And if not, is there some other way that you can play this theme?
And we had lemon tree in our portfolio post-COVID. We had added, and then we exited recently. And the reason was exactly what you said, Niraj, that I think a lot of their valuation is now well into frothy zone because of populism of these companies' stocks right now, and also the fact that there is some scarcity. So if large investor wants to allocate a reasonable amount of time, amount of capital into hotel segment, there are very few names that are available. So I think that is driving some of these for the valuation, but I think the earnings are not going to be as high as people expect them to be, because these are businesses that are driven by very high capital inflow. So every time they grow, which is either by acquiring a hospital or a hotel or taking a contract of a hotel, they have low margin, high capital businesses that will struggle for growth beyond a point. So I think it's a good secular theme going forward, but it's still kind of the valuations are not that attractive anymore in this whole segment. I think the returns have been made, whatever was to be made between COVID and now, the returns have been made. So in hospitality sector, if you look at it, travel, there is Indigo, which is probably the only airline that one could invest in. And then there are, restaurant stocks, but they have also disappointed. You look at most of the QSR companies have struggled for growth in the last one quarter because of seasonality and, some of the other factors. Then you have the movie chains, PVR, again, stock is probably, grinding towards its 52-week low. So, Niraj, what is happening is that while it is a good, attractive theme, the whole tourism space, but the problem is that there are not enough plays in this that an investor can look at. And I think that's one of the reasons that whatever is worth investing in is already so expensive that you wonder what kind of return would you generate by investing in them at this current price.
Point well taken. Sadly, we are out of time, because otherwise I would have loved to ask Abhay Agarwal about his 8% allocation to EMS or media 4.5%, which is not something that we've started seeing, but not a very dominant piece in most portfolios. Maybe we'll save that for another time. But this was lovely too, Abhay. Thank you for taking the time out and being with us today.
Thank you, Niraj. It's my pleasure. Thank you.
And the pleasure was entirely ours. And viewers, thanks for tuning in to yet another episode of The Portfolio Manager.